Hello, everyone. Welcome to our breakout session, Inclusive Finance, Research on Credit Union Growth and Relevance. I am your moderator, Armando Martinez, board member for Inclusiv. Before we get started, I wanted to share some housekeeping pieces. All sessions will be recorded and uploaded within 2 weeks. The recordings will be accessible the same way that you access the session through the conference center, and later you will find them on the Inclusiv website. To maintain the integrity of the recordings, we ask all participants who are not speaking to please mute their microphones during the session. We encourage you to put your view into grid view in the top right of your screen. This enables you to see all the other session attendees. Time permitting, we will have a question and answer period at the end of today's session. Please use the chat to ask questions for the presenters, and we will pass them along to the session moderator. Send your questions to the participant named Questions for Speakers with 2 asterisks. You should find them at the top of the participant list. We do encourage you to share any insights you are learning via social media with the hashtag CDCUCON2020. If you experience technical issues during this presentation, please feel free to send a private chat to our tech team at AdvancedNet. Now, I have the distinct privilege to introduce 2 phenomenal subject matter experts. Terry Ratigan serves Inclusiv as a senior consultant and is a leading analyst of credit union performance and impact in low-income and underserved communities. In 2010, Terry developed a statistical methodology to evaluate credit union activities in CDFI target markets and eligibility for CDFI certification that has been used for hundreds of credit union certifications to date. An adopted version of this methodology served as a basis for the 2011 revision of the NCUA final rule on low income designation and CDFI guidance, fund guidance on target market analysis. Samira Salem is the Vice President for Diversity, Equity, and Inclusion, DEI, at CUNA. She has nearly 20 years of experience in international economic development, community development, policy research, and social finance. She joined the Credit Union National Administration, CUNA, Association CUNA, in 2018 as a senior policy analyst in the Research and Policy Analysis Division. Prior to joining CUNA, she worked for Forward Community Investments, CFCI, Madison-based community development financial institution that serves communities throughout Wisconsin. If I could ask Terry to start us off.
Thank you, Armando, and I will share our presentation for this afternoon. Welcome, everybody. I'm very glad that you could join us for this discussion. We're going to be talking a little bit about some recent research and some new insights that we've had on the connection between financial inclusion and financial performance. And I'd like to start with a question. For all of us, when we see low-income members in marginalized communities around the country, or close to where we live, close to where we work, do we see risk or do we see an opportunity? And I think most, if not all of us on this call would say we're credit unions. Of course we see both. But for community development lending, low-income markets, what the CDFI fund refers to as CDFI target markets, are often classified and viewed primarily through the lens of risk. CDFI certified credit unions, and currently there are about 320 CDFI certified credit unions across the country, primarily focus on high-risk communities and populations. One of the requirements of of becoming certified as a CDFI is that more than 60% of your loans are going to these populations and communities, economically distressed areas that are generally perceived to be of higher risk. In 2016, NCUA issued a supervisory letter on the examination and supervision of CDFI credit unions. What is striking about this particular letter, and I should say at the time, Inclusiv, which had worked for many years and continues to advocate with NCUA to understand the particular characteristics of CDFI and community development credit unions, welcomed this effort to provide some additional guidance to its examiners when they're visiting community development credit unions and examining community development credit unions. But the elements that are highlighted in NCUA's letter reflect their predominant focus on characteristics of risk. Things like higher operating expenses, higher delinquency rates, which are true, but NCUA's letter did not actually, and their analysis, and I would say this is largely to date, did not take into effect elements of the community development credit union business model that successfully manage those risks. NCUA may not have looked at those things, but at Inclusiv we have. And our findings are reflected in these two reports that we published in 2018 and 2020. And in looking at the totality of the financial data, comparing CDFI credit unions with their median peers in every asset class, we found a major key finding that credit unions have focused on financial inclusion. In other words, credit unions that are most focused on the communities that are considered higher risk actually are more profitable, they're growing faster, and they are more active lenders than their peers across the industry. The report that was published in 2018 looked at just 1 year's data, although we had been internally looking at that data for several years. The newly published report, and both of these are available on the Inclusiv Finance site, the 2020 report actually looked at 5 years worth of data in a couple of key, a couple of key areas. Sorry about that. Still working the technology here. So this is 5 years worth of data. The gray bars represent the median performance or the median values for non-CDFI credit unions. The fat colored bars represent CDFI credit unions. So if we look at earnings, return on average assets, CDFI credit unions consistently have shown higher earnings than their mainstream peers. If we look at lending, this is loans to assets ratios. CDFI credit unions are more active lenders than their mainstream peers consistently. When we look at asset growth, CDFI credit unions consistently are growing faster in terms of assets than their mainstream peers. And here is a particularly notable part of the industry. So each of those bars represents a different asset class, from the smallest on the left, from the smallest peer groups to the largest credit unions on the right. If we look at small credit unions that have, for decades now, been closing at a disproportionate rate. On average, we're losing one small credit union every business day as the industry consolidates. You can see that the median non-CDFI credit union under $2 million actually got smaller over the last 5 years, while the median CDFI credit union managed to grow. So the performance of CDFI credit unions in the smaller asset classes is particularly noteworthy compared to industry-wide trends. And if we look at membership growth, another key indicator, we see the same trends. And again, CDFIs with less than 50 million in assets are defying industry-wide trends. So many of you have seen this data. We've presented it in a number of different conferences and webinars in recent years. And I encourage you any of you that haven't seen the reports to go into the reports where the findings are detailed a little bit more. But I want to actually move beyond just the basic findings of these reports and talk a little bit about more recent research we've been doing into the connection between CDFI certification and what we generally talk about as financial inclusion. Many of you may have seen this analysis, this industry-wide analysis that we do on a yearly basis as well, that looks at CDFI credit unions as being a product of two main factors. One is having the opportunity to serve CDFI target markets, being located in areas in close proximity to economically distressed investment areas, low-income populations, and the like. So the more concentrated you are in this particular representation, the higher your opportunity, the further you move to the right. The second factor is how you respond to that opportunity. It's one thing to say that our credit union is located in an area that has a lot of economically distressed communities. But if you are only narrowly serving the wealthiest segment of that community, then you're not responding to that opportunity. So every year we do an analysis of all the credit unions based on public data and looking at not only where they're located, the economic distress criteria of where they're located, but also the kinds of products and services that they offer that are responsive to those opportunities. Currently, each of those dots represents a different credit union. I won't ask you to identify your own credit union on that map, on this matrix, but currently there are about 800 credit unions in what we call the CDFI zone. About 1/3 of them are currently CDFI certified. I'm pleased to note actually that currently we are also working in partnership with CUNA Mutual Group to try and see what we might be able to do together to get more of those uncertified credit unions in this zone to look at CDFI certification. So we're very excited about that. So shout out to our friends at CUNA Mutual Group. In addition to those credit unions that have a high opportunity and high response, I've always been very intrigued by the credit unions that are located in areas with very low CDFI target market opportunities, but that also seem to have the products and services that will respond to their lowest income members. These high response, low opportunity members may never, or credit unions may never become CDFIs. It may just, because of where they're located, they might not have the opportunity. But they are financially inclusive, at least they appear to be. So the question is there a measure for financial inclusion? First, before trying to answer that question, I want to be clear on what we're talking about when we say financial inclusion. By financial inclusion, we're talking about extending the benefits of a regulated financial institution to those whom are most often excluded from the financial mainstream. So we're talking about residents of economically distressed geographic areas that are defined by the CDFI fund as CDFI investment areas. We're also talking about low-income families and individuals and communities that have experienced historic exclusion from the financial mainstream. So communities of color that have experienced redlining and other forms of persistent discrimination. So let's look at two examples of what we might mean by credit unions and financial inclusion. How can we measure or begin to estimate what we mean by financial inclusion? So we're going to look at two places. Apple County, which is served by Apple County Credit Union. And we're going to, just a full disclosure, we're going to get into just a little bit of math here. But Apple County Credit Union only serves members of Apple County. 25% of Apple County residents live in CDFI investment areas. But 40% of Apple County Credit Union loans are made in those investment areas. And remember, Apple County Credit Union only operates in Apple County. They don't have any activities outside. And 40% of their loans are going in CDFI investment areas. Now, to be a CDFI, you need 60% of your loans going in there. So Apple County is way off the beam. They are not eligible to be CDFI certified. But if you look at how many loans are going to the investment areas compared to their opportunity, the ratio of their lending to their opportunity is 1.6. A ratio of greater than 1 of what you are actually lending compared to your opportunity in your area indicates that you are financially inclusive. So for Apple County Credit Union, we can say that it is a highly financially inclusive credit union, even though it's not eligible to be a CDFI. So let's look at Pear County Credit Union, which serves Pear County. As you can see, this is a very healthy example because it's only using good, healthy foods. 75% of Pear County consists of CDFI investment areas. So there's a lot of target market opportunity in Pear County. 75% of the population lives in economically distressed areas. 60% of Pear County's credit union loans are issued in those CDFI investment areas. Now that meets the 60% threshold for CDFI certification, so they can be a CDFI. However, if we do that same ratio that we did for Apple County, we see that the ratio of their actual lending to what their opportunity is 0.8. It's less than 1. And ratios of less than 1 indicate a less financially inclusive credit union. So what do we think of Pear County Credit Union? We can say that Pear County is less financially inclusive. However, it is eligible for CDFI certification. So we have a case where there's a low target market opportunity, but you can still be financially inclusive, and a credit union that is not financially inclusive or less financially inclusive, but is CDFI eligible. The financial inclusion ratio that we're using in these two examples, we also refer to it as something of a mission metric. Any credit union could use this financial inclusion ratio because it is independent, whether or not you're eligible for CDFI certification. Any credit union actually could look at this type of a ratio to say, you know, how are we adhering to our credit union mission, not necessarily a CDFI mission. So the question then is, okay, how financially inclusive in general are CDFI credit unions? So I have another map for you, another matrix. So on the bottom, I have the what we calculate as the investment area ratio. So this is very much like the Apple County and Pear County examples that I just talked about. So compared to the investment areas in a credit union's area, how many of their loans are going into those investment areas? And on the vertical axis, we're looking at low-income geographies that are different than investment areas, but are similarly defined. So compared to those low-income geographies, how many loans are actually going in those areas? That line, that box, represents ratios of 1. So if a credit union is right on that line, that's a 1-to-1 ratio. That would indicate a credit union that is lending in exact proportion, that is lending to target markets, to distressed populations in exact proportion to their presence in their community. Further to the right, outside the box, is the most inclusive, and inside the box is the least inclusive. How do CDFI credit unions look? Well, about 2/3 of CDFIs are that, and I should preface this by saying this data analysis is based on a review of 122, roughly a third of a little more than a third of all certified credit unions based on their 2019 loan data. About 2/3 of all CDFIs look to be highly inclusive, with a strong focus on target markets in their service areas. We do see that there are CDFIs. These are fully certified. These are more Pear County CDFIs that are located in areas of high density target markets, so they can qualify as CDFIs even if they appear to be less inclusive. So they could be doing even more lending in those CDFI target markets. A question we're talking a lot during the course of this conference, and Samira will be speaking more about this in a few minutes, about diversity, equity, and inclusion. So up to this point, I've been talking about financial inclusion. What about diversity? Does that factor into this equation? I'm glad you asked that question. So the financial inclusion ratio that we've just been talking about compares actual lending in specific CDFI target markets with the opportunity to lend into those same markets. So that's the mission metric. How much are you fulfilling that market? How much are you leaning in to the historically excluded communities and populations in your area? That's the financial inclusion ratio. We can't actually do the same kind of a ratio for credit unions in terms of diversity, because fair lending regulations get in the way. Credit unions can't track the race and ethnicity of all their members outside of HMDA reporting on mortgage loans. That's just not an area that regulated financial institutions, banks or credit unions, can go to. So we can't calculate a similar diversity inclusion ratio. However, what we can look at is an index of how diverse the communities are where credit unions are lending. So Inclusiv has calculated a diversity index that looks at, again, for those 122 CDFI credit unions, looks at the diversity of the communities based on census data where they are lending. If we look at across the United States, the average census tract in the United States, if you just picked one at random, you would expect a diversity index ratio of 27%. So that would be the baseline for the United States. That's all 50 states, including the District of Columbia and Puerto Rico. If we look at the 122 CDFI credit unions, where their loans were going, we found an average diversity lending index of 37%. So a slightly higher diversity lending index. Now, among these credit unions, there were 33 that are designated as minority depository institutions, or MDIs. Not surprisingly, their diversity index was 72%. So how does that look? You know, the financial inclusion ratio here is on the bottom. The diversity index is on the left, going up. And what we see is that the diversity of communities served by CDFI credit unions covers the full gamut of what you would see across the United States. From communities that are, you know, where the diversity is practically close to zero, all the way up to close to 100%. Again, the average diversity ratio for the CDFIs in our sample was 37%. Now, on this chart, remember that credit unions may be able to influence their financial inclusion ratio, how much they are focusing on underserved communities in their area. Credit unions cannot really influence their diversity index because that is reflected in the community that they serve, other than by moving their lending to more diverse areas. But in many parts of the country, you know, for many credit unions, you know, the diversity index, you know, pretty much in their area is the same. Whether it's high or whether it's low, their communities are, you know, the composition of the communities they're serving is not something that credit unions can directly influence. That said, there is an interesting influence, or an interesting correlation. If we look at the correlation between the diversity of the population served by a credit union and their financial inclusion ratio, we see a positive correlation. In other words, the more diverse a community, the more inclusive a credit union tends to be. We do not know whether this is just a trick of statistics at this point or a small sample size, but it is an intriguing relationship that we plan to dig into a little bit deeper in the days and weeks to come. It's certainly a relationship we want to look at. It's also interesting that when we look at minority depository institutions, as a group, the 33 MDI credit unions in this analysis had an average financial inclusion ratio of 1.26, which is very high. Non-MDI CDFIs also have an average inclusion ratio that's above 1, which means they are leaning in, but they do not appear to be leaning into those target markets to the same degree as MDI credit unions. Now, I should just specify that that the financial inclusion ratio does not take into account race and ethnicity. So the financial inclusion ratio is looking at geographically defined distressed communities. Even so, even without taking that into account, we do see that minority depositories tend to be leaning into those opportunities they have more so than non-MDI CDFIs. Again, some questions for further investigation and further research. And with that, I'm just going to wrap up by repeating again the key finding here. You know, we opened up with the question of saying, do we see opportunity and risk You know, there is obviously risk in lending to economically distressed communities and individuals. As credit unions, we know our job is not to avoid risk, but to manage it. What these research reports, what our findings have shown is that CDFI credit unions have demonstrated that it is possible to successfully manage those risks. That the magic does not happen just by virtue of being certified as a CDFI, or by suddenly just rushing headlong into into you know doing riskier, just taking on more risk. It is managing a risk, but CDFIs, it is a sustainable business model. Um, at the annex of both of these reports actually provides uh, financial performance ratios broken out by CDFIs and non-CDFIs that validate not only the NCUA's um, findings from that supervisory letter that they put, that CDFIs do generally tend to have higher operating expense ratios, higher delinquency ratios, and the like. But it also will show that CDFIs also are more loaned out. They tend to have higher loans to asset ratios, higher yield on average loans, higher return on average assets. So it is a complete business model. It is not just something that is defined by risk. So with that, it is my pleasure to turn the microphone over to my friend and colleague, Samira Salem. Samira, would you like to take it away?
Sure. Thanks, Terry. Good afternoon, everyone. Thanks to Inclusiv for the opportunity to join Terry and Armando in this session. And Terry, I really appreciated you sharing your research. I think it's super cool and super valuable for the credit union industry, in particular for CDCUs. But I think the message that comes out very loud and clear is that credit unions that focus on financial inclusion perform better. We do well by doing good. And the research that I'm going to share is some research by CUNA that supports that very same idea. So I wanted to start with a little bit of context on Latinos in the United States. The research that I'm going to be presenting really focuses on some work that's done not only by Inclusiv through the Juntos Avanzamos designation, but also Coopera's Hispanic outreach program. So we did an evaluation of these programs. And, I'd like to put into context what reaching and better serving the Hispanic, the Latino market means. So when we look at that market in the US, the economic contributions of Latinos in the US, it's extraordinary. The growth rate is actually dizzying. And if you were to take the total economic output of Latinos in the US, which in 2018 was $2.6 trillion, rank it against the rest of the world, it would rank 8th in the world. Okay. This is larger than Italy, Brazil, South Korea. And the pace of US Latino GDP growth is incredibly impressive. It grew 72% faster than non-Latino GDP between the period of 2010 and 2018. We know that the single largest driver of this rapid Latino GDP growth is personal consumption. And this comes from gains in personal income. It's also connected to educational attainment, strong labor force participation. The number of Latinos with bachelor degrees or higher between 2010 to 2018 grew tremendously. And it was 2.6 times more rapid, the growth for Latinos than non-Latinos. Latino labor force participation in 2018 was 67.7%. That's more than 5 percentage points higher than non-Latino labor force participation. And so despite being only 18.3% of the US population, Latinos are responsible for nearly 80% of the growth of the US labor force since the Great Recession. So Latino consumers wield $1.5 trillion in buying power. This is higher than any other racial or ethnic group of color. And with a median age of 28, they are younger than any other racial or ethnic group, which means their income and spending power is going to grow for many years to come. But we also have to keep in mind, which I'm sure all of you know very well, Latinos are not a monolithic group. They come from at least 15 different origin groups, from Mexico, Puerto Rico, Cuba, Guatemala, Peru, so on and so forth. Sorry if I left out your country. In addition, the economic situation, the median education level of Latinos can vary significant depending on their group of origin. So this has, of course, implications for their financial profile, their needs, the challenges they face, the goals of Latinos. And I think for credit unions, that's important to consider. So now we're at the right slide. We'll stay here for a little bit. So despite the enormous and fast spending growth in their spending power, the relative youth, the fast population growth, financial inclusion is a real issue for Latinos. Approximately half of them are unbanked or underbanked. And to put that into perspective, only 1/3 of whites are unbanked or unbanked or underbanked. Again, just want to underscore that financial inclusion is an issue for Latinos. So how well are credit unions doing when it comes to financial inclusion for Latinos? We took a look at the most recent survey of consumer finance from the Federal Reserve to answer this question. And we know that while Latinos make up approximately 19% of the US population, they only make up 6% of credit union membership versus banks. I come from the advocacy, side of CUNA. So I always kind of look at where the banks are, that's 10%, right? And if you look at all of the other racial or ethnic groups, this is the one group where we see a real opportunity for credit unions to do better. And so the question is, why are we not reaching and serving a larger percentage of Latinos? How can credit unions do a better job of serving this group? And then what does serving this group mean for the credit union's bottom line? We know there's an opportunity here. As Terry, I love the opportunity risk, right? But do we need to worry about higher risk? Will there be higher delinquencies, higher charge-offs? These are the sorts of questions that emerge. So I'm going to stick a pin in that question. I want to get back to it in a minute. I think we can move. Thank you, Terry. So here's the DEI stuff. There are more than 3 decades worth of research that finds that DEI is good for business, right? Diversity, equity, and inclusion. And the research finds that it improves organizations' competitive advantage, it boosts profits and earnings, it spurs innovation, reduces risks, it'll enhance your employee and customer satisfaction, attract top talent, and it'll help you improve your employee retention. I mean, on and on and on. There is tons of research out there. And in addition, we know the other part of the business case is because of changing demographics, where people of color within 20 years will become the majority in the US. DEI can also provide access to credit unions to a growing market, right? It's about relevance. And at the end of the day, it's about, some even put it as stark as to say is it's about our survival. So there are two other parts of this case. The values case, obviously, DEI is deeply connected to our values as credit unions. It is, at the core and the genesis of credit unions was about financial inclusion, providing those people that were excluded from the financial services industry an opportunity to bank. And we say it's in our DNA, right? The other piece of it is that policy makers and regulators are prioritizing DEI. But I want to really focus on the business case because all of this research that I just cited comes from outside of the credit union sphere, right? So we'll see research from Deloitte, from McKinsey, focused on the corporates. And that's not a bad thing. And, we feel like there is a strong case to be made that, in fact, a lot of these results carry, right? But we wanted to take a look at what's going on when it comes to the business case within the credit union movement. So, like I said, while all of this research is robust, and we feel like it would apply directly to credit unions in terms of that strong business case, we wanted to take a look at how credit unions that diversify their membership and apply DEI principles, how do they fare when it comes to operating results, including asset quality? So the opportunity and the risk piece of this. I'm going to have you go back one more slide. We'll hold there for a second. Thank you. So we conducted a rigorous evaluation of Inclusiv's Juntos Avanzamos designation and Coopera's Hispanic outreach program. Specifically, we wanted to evaluate the impact of participation in the designation in the Hispanic outreach program on credit unions' growth, earnings, and portfolio quality, right? So now we can move on. We'll reveal the results. And what we found was really impressive. I think it kind of, while we thought that the business case would hold, it was pretty astonishing what we found here. So in terms of the Juntos Avanzamos designation, I'm not going to do it justice, but essentially it is a designation for credit unions that are committed to, not only outreach to the Hispanic community, but to really serving the Hispanic community right. So they apply sort of DEI principles, in their work, so that their staff reflect their community. They understand their community. They understand the challenges and barriers that the Latino community, whether they're immigrants or whether they're first or second generation, that they face in the United States, and they actually, in a very intentional way, identify policies and practices to reduce those barriers and to better serve these groups. So the designation is basically a commitment to a whole set of criteria that, yes, you are going to commit to not only reaching, but better serving the Hispanic Latino community, right? And so we evaluated this program. And what we found was that those credit unions with the Juntos Avanzamos designation, they grew their membership by 28% more than credit unions that didn't receive the designation. 28% more, okay? Those that, they also experienced 40% higher increases in loans, 26% higher increases in assets. And we found no statistically significant increases in earnings or portfolio quality. And so that idea of the risk, right? We didn't see that emerging here when it came to Juntos Avanzamos, right? We saw the real opportunity, but the risk, there was no significant results around the portfolio quality in terms of this program negatively affecting portfolio quality. So we did the similar evaluation. And again, this was a rigorous evaluation. We did for difference in difference. We use difference in difference methods and regression analysis to do this. And we were able to control for a whole host of factors. Again, we see these incredible results with Coopera's Hispanic Outreach Program. Credit unions that participated in that program grew their memberships by 33% more than credit unions that didn't. They experienced 44% higher increases in loans, 31% higher assets, and 0.32% greater earnings than those that did not participate in the program. And to a much weaker extent on the risk side, portfolio quality, we measured it by looking at delinquencies and charge-off ratios. They actually showed improvements for credit unions that participated in Coopera's Hispanic Outreach Program compared to those that didn't. Now, the Coopera's Hispanic Outreach Program is different than the designation. I see the question there. I can put in the chat the links to both of the programs, but Juntos Avanzamos is a designation. So you have the eligibility, you work with Inclusiv to ensure that you meet the eligibility. They might work with you a little bit on a couple of issues. If you have questions, that sort of thing, there is some support. And I will say that the Coopera's Hispanic Outreach Program is more of a, they provide support around strategic planning. It's more like technical assistance, consulting rather, to work with credit unions to get them to the place where they could potentially, for example, then get the designation. So, oftentimes credit unions might actually see these as being complementary. If you're kind of just starting off in this space and this isn't work that you've been doing for a long time and you really need a lot of help, Coopera is a great place to go because they have a lot of resources, consulting services, that sort of thing that help you, from soup to nuts, on understanding the Hispanic market and how to better serve them. So that's more of the training, capacity building, technical assistance, consulting side of it. Whereas the designation is, once you've reached a certain level, let's make a commitment. And that's what the designation stands for. So I'm sure others could do a much better job of explaining it, but in a nutshell, that's kind of the difference there. Again, they're complementary. Credit unions could use both, one or the other. And I will try and add in the chat before we close here the links to both programs. So bottom line, there is an opportunity for credit unions to better reach Latino households. I started off by showing you that data that shows us that there is an opportunity here for credit unions. We're not doing as good a job as we could. And that our research shows that there is a business case, right? That credit unions that are intentionally financially inclusive and are serving Latino households are more profitable. They grow their memberships, loans, assets, and the risk is pretty much non-existent. They're not harming their portfolio quality, and in some cases, they're actually improving it. Thank you.
Awesome. What a great presentation. Thank you both, Terry and Samira. Is there any questions of which we can present for discussion? If you have some, would you please just send it to questions for speaker? I did receive one from Ed Savak at Hope Credit Union. He was referencing the inclusive analysis that Terry presented as fascinating. He indicates that it was nice work. So thank you for that, Ed. And so his question is, what do we know about the less inclusive CDFIs? And it's a two-part question. So if Terry, if you could respond to that, please.
One of the things that we know is what I mentioned briefly during the presentation. Because they are CDFIs and they are still meeting their target market requirements, we know that they are located in areas of higher target market opportunities. So it's in a sense easier to still remain CDFI certified because they have the opportunities there. This analysis is still pretty new, so we haven't gone to the levels yet to say, you know, and this is some of the investigation that we definitely plan on doing, looking at the profile in terms of asset classes of the credit unions, the types of lending that are more or less concentrated. I should specify something, that the financial inclusion ratio is based on number of loans in areas. It is not weighted by dollars. And that's an important distinction. That actually, you know, provides, if anything, more of a cushion. So we didn't want to, you know, kind of distort or complicate the analysis by, you know, having mortgage loans or business loans or, you know, commercial real estate that could really pull the index in one direction or another. So it is straight up, you know, out of the total number of loans weighted by where they are deployed. But we do very much want to start looking a little bit deeper in the analysis. The other thing that I will say is, when we're looking at, because what we're talking about here are the pair county credit unions, right? We're talking about credit unions that have, you know, in Pear County, 75% of the opportunity is in investment areas, but that's only 60% of their loans. The other thing that we know from the inclusive finance research is that if they're focusing 40% of their lending outside of, you know, on that 25% of the market that is outside of their investment area, we know quite a bit of that from experience. One of the things we know about that 25% is that that area proportionately is much more banked. So the credit union is competing with many more banks, even other credit unions and other lenders, for that slice of the business. We know, because the data tells us, that the yield on the lending, that 40% that they're focusing on the, shall we say, overbanked segment of their market, is probably the least profitable lending that they are doing. So there is a lot more that we want to, a lot more opportunity to dig into this data, and, you know, your questions reflect a lot of our research interests as well.
Thank you very much, Terry, for that. I have a question for Samira, if you would please. Does CUNA evaluation consider credit unions of different asset size?
Yeah, that's a great question. Yeah, it actually does. So the regression analysis that we used, we were able to control for a number of different factors, which means that we're able to eliminate the alternative explanation that it's asset size that's driving the results, or it's location that's driving the results. So we controlled for a number of factors, including asset size, including location, including regulatory changes, technology, economic growth, really trying to whittle it down so that the impact that, or the effect that we were seeing was coming from the programs as much as possible.
Very well. We are now at 3:25. So I'd like to, if there's not any additional questions, I would like to express our thank yous to our wonderful speakers for sharing their insights and strategies with us. We will now take a break with an intermission for 15 minutes and come back together for our next plenary session, where we will all hear about the role of community development credit unions having played in combating climate change and building a more equitable financial landscape. This Zoom session will close. You can proceed back to the conference homepage to access the links for the plenaries and enter the Zoom meetings. We welcome you back at 3:45 Eastern Standard Time and look forward to seeing you back in the plenaries. Thank you very much for your attendance here today and hope that you've gained some valuable insights on how we can continue serving the underserved. Thank you again, Terry and Samira. Great work.
Thank you, Armando.
Bye, everyone.
Thanks, everybody.
Bye, Armando.
Thank you.
Everybody.